All right, thank you everyone for joining the PACE in Virginia webinar. My name is Jessica Green, and I'm the Program Coordinator with the Virginia Energy Efficiency Council. We are excited to kick off this webinar series and aim to provide them quarterly. These webinars are in response to the membership survey last year that indicated a desire for more knowledge sharing and skills building opportunities, and from a poll last summer for PACE as the top choice. PACE will be a topic at our November 29th meeting, so mark your calendars. Registration will open soon. We have 3 speakers joining us today, all with ample knowledge and experience in the PACE field. We'll be hearing from Alyssa Roth, Director of Policy and Market Development with PACE Nation, Abigail Johnson, President of Abacus Property Solutions, and Bill Greenlee, Loan Officer and PACE Specialist with Virginia Community Capital. Alyssa Roth joined PACE Nation in January 2016 after working with Energize New York State's PACE program for 4 years. She has spent her career working in the clean energy sector, primarily under several marketing and outreach contracts for the New York State Energy Research and Development Authority. She currently serves on the board of directors for 2 nonprofit organizations in Westchester County. Abigail Johnson, a lead AP O&M, is the president of Abacus Property Solutions, Abacus, and founding partner in the new venture Atlantic PACE, a PACE project development and program administrative firm. In 2009, Abby founded Abacus to serve as an independent real estate advisor to the commercial real estate industry in financing, energy efficiency, and clean energy projects using conventional debt, public-private incentives, and alternative financing vehicles such as PACE. Over the past 3.5 years, Abby has focused her energy in growing the PACE market, both from the origination and underwriting standpoint to working with government and nonprofit entities in establishing PACE programs. In particular, she was instrumental in establishing a commercial PACE program in South Florida and in amending the flawed Virginia PACE legislation in 2015. Bill Greenlee is a commercial loan officer at Virginia Community Capital. He started Virginia Community Capital's energy efficiency and solar lending program for commercial buildings in 2015. Bill first started working to bring PACE loan programs to Virginia in 2009. In 2014, he established a business coalition which successfully secured passage of Virginia's PACE legislation in 2015. He serves on the board of the Virginia Energy Efficiency Council. Here is our agenda for today. Our speakers will be covering an overview of PACE financing, value proposition for property owners and contractors, a few case studies, and what PACE looks like in Virginia. Now please turn your attention to Alyssa Roth, who will be giving us an overview of PACE.
Great. Thank you so much, Jessica, and thanks to VAEC for having us on the call today. We're thrilled that Virginia is recognizing PACE as a topic of priority. You can go to the next slide, please. So PACE Nation, for those who aren't familiar with it, is a nonprofit organization that is funded by foundations and by members to provide guidance and support to the growing universe of property-assessed clean energy market participants. So that includes everyone from financiers and contractors, solar installers and building developers, to PACE program administrators, government leaders, elected officials, and anybody that has any interest in learning about PACE or helping to grow the market. So you can become a member of PACE Nation for free by visiting pacenation.us/register and join our member network by activating a member profile, which will make your company visible to the rest of the market and also gain you access to see all of the other players that are involved right now. Next slide, please. So I'm going to give a brief overview of the very basics of property assessed clean energy and what makes it different from typical lending mechanisms. So PACE is a tax assessment-based financing mechanism, which means that it is actually included in property taxes as an assessment or a line item on typical property taxes. PACE can be used for renewable energy, water conservation projects, and always energy efficiency. Next slide, please. There are the rule of thumb when it comes to measures that can be financed using PACE is that it needs to be something that reduces the energy consumption, generates energy, and is permanently affixed to the property. Because the financing becomes a line item on the tax bill and essentially travels with that tax bill and not with the property owner, we want to make sure that all of the measures installed using PACE also travel with the property and cannot be removed by the property owner. So that includes everything you see here, like heating and ventilation, typical HVAC upgrades and improvements. It can even include roofing if it makes sense for a solar project or increases our value of the envelope. Really the exception is we can't just do lighting or put in light bulbs. We have to make sure that the ballasts are changed and that it is permanently affixed to the building. But other than that, any project that reduces energy can be financed using PACE. Next slide, please. When it comes to the type of buildings that can use PACE, the general rule is that it's anything that is privately owned. And that includes offices, manufacturing, industrial, retail, hospitality, hotels, agriculture, and even residential. In Virginia, we're concentrating primarily on commercial, but I guess the biggest point to make here is that PACE cannot be used on publicly owned properties, such as government buildings or municipal properties. And that's because the municipality cannot place a line item or place a lien against themselves and enforce that lien. And government buildings usually have access to other loan options and products that sometimes even have better rates than PACE. So PACE is really designed for the private sector. Next slide, please. So there are 4 parties that are always involved in any PACE deal. And this is how the flow of capital would typically work in a closed project. So a PACE program is created and established by a government and is administered by that government or by a third-party administrator contracted by the government. And that administrator is responsible for approving projects and approving customers. So they review applications, they work with the contractors and installers or other energy service professionals, and deal with all of the background information for getting a PACE project set up. The next player is the source of capital, and that can be either government bonding or private PACE lenders or any other financing opportunities that are available to the municipality or to the administrator. So after an application is approved and a customer is approved by the administrator, the capital provider will disperse funds to complete the project. Then the energy service professional comes in, and that would be either a solar installer, a general contractor, or a certified energy service professional to complete the work using the funds that have been dispersed by the capital provider. And the last step is that the property owner then receives an assessment on the property taxes and repays the loan or pays for the project through the regular property taxes. The municipality then receives that payment and separates out the PACE portion and remits it back to the capital provider. Great, thank you. So there are 4 benefits of PACE that reverberate throughout the market regardless of which program you're using, which state you're in, how your PACE program works. There's always 4 classic benefits. And these are things that are different from going to a typical bank or a common lending institution to get funding for a clean energy project. The first benefit is that PACE can cover 100% of a project's hard and soft costs. So soft costs would include things like applications, if there's an energy audit required, and any other administrative fees. PACE can roll that in. And by funding 100% of a project, that means there's no need to put any money down up front or come out of pocket for the property owner. Typical banks right now, we see lending about 85% for clean energy projects. So the property owner does need to come up with around 15% most of the time to get the project done. So this is a really, really good option for property owners that don't necessarily have great access to capital, like nonprofits, or have typical credit history, like multifamily houses. The next benefit is that all PACE financing can be used for up to 20 years, with terms up to 20 years. And the reason that's so valuable is because that means we can look at projects that have paybacks of up to 20 years. Right now, typical banks will only lend for 7 or 8 years for a clean energy project. And that means you can only do a project in most cases that will pay itself back in 7 or 8 years, which excludes a lot of times big solar upgrades or deep energy retrofits that take a comprehensive approach and have longer paybacks. So because we can look at 20-year terms, that means we can look at deep energy saving measures that really have an impact on the energy usage and the financials of the property. Next slide, please. The other benefit of having that 20-year repayment term is that most projects will be cash flow positive because the repayment terms can be stretched out to 20 years as long as that doesn't exceed the useful life of the measures cumulatively. So that means the payments that you're making annually on the property taxes are less than the amount you're saving annually on your utility bills. In essence, you're paying for the upgrade through the savings you're receiving from that upgrade. So because we're 100% financed, that means there's no money out of pocket, and you're also seeing cash flow come in on an annual basis due to the PACE project. And the last benefit is that PACE is transferable. So because it is attached to the property taxes and not attached to an individual or to a business, that means the assessment stays with the property and doesn't need to be paid off if that property is to be sold before the PACE assessment has been fully paid off. So this is especially valuable for property owners that don't know their future beyond the immediate, 3 to 5 years. They can upgrade their buildings and potentially save the money that they need to maintain or sustain those properties, or they can choose to sell and the PACE financing automatically transfers to that new owner, as well as the savings, both energy savings and financial savings from the energy upgrades. Next slide, please. This is a snapshot of the commercial PACE world today. So this illustrates both legislation and launched programs. In order to establish a PACE program, the first step is to pass legislation at the state level that enables the use of taxes, property taxes, and assessments for clean energy projects. And the second step is to establish a program by an administrator. So this map shows that right now we have 32 states plus DC that have passed legislation at the state level, and 19 of those states have gone the next step and actually started programs. And then we can see all those red dots are the states that have actually funded programs or funded projects with the programs that have been launched. Next slide, please. Great, thank you. So this is the last slide for me today. It's just an overview of the upgrades and improvements we're seeing so far in the PACE world. PACE is relatively new. The concept was really created in 2008 and didn't get off the ground truly until about 2010. So in the last 6 years, we've seen CPACE and our PACE is residential and CPACE is commercial grow at tremendous speed. And residential projects really are concentrated in California at this time. The commercial projects show more of a national perspective, and we're thrilled to show that renewable energy, solar, sometimes geothermal and wind, but primarily solar, make up over just about half of all improvements, and other energy efficiency measures make up the other half. So that's it for me today. Thanks again, Jessica, for having Pace Nation on the call, and I'm happy to answer any questions at the end.
Thank you, Alyssa. We'll now turn things over to Abby Johnson, who will be covering the benefits of PACE for both contractors and building owners, and will share case studies.
Thanks a lot, both to Alyssa and to Jessica, for this opportunity. I just want to say that I think that Alyssa's overview is very good and comprehensive, and really, I think, gives a good, shows a value proposition of PACE financing for a number of stakeholders. You can just go to the next slide, please. So just a quick overview about our company. We provide energy efficiency consulting service to the commercial real estate industry, basically serving as owners' reps and upgrading buildings. Over time, the last 3.5 years, we have seen our focus really be in financing of these energy solutions because, as Alyssa alluded to in her presentation, this is often a big issue with a number of property owners, specifically nonprofits and smaller companies that don't have the capital to make upgrades that they may need. So we really have found this to be something that is extremely innovative, really is going to, we feel, move the proverbial needle towards greater energy efficiency and use of renewables. But I just want to put a little perspective into why we really have focused on energy financing, PACE specifically, and why we think that this will have a greater impact over time than other kinds of financing. So basically, when we would look, when I was working in a large commercial bank as an asset manager, we would see, many, many projects come through the door. We would have to evaluate them. And we would see often the need for capital improvements and the fact that often if the building, the building HVAC system worked, even if only moderately, or even if it was, 25, 30 years old, there was a hesitance in replacing that equipment if that competed with another project that, in the eyes of the building owner, would generate greater revenue today. So if I'm a Class B building sitting across from a Class A building, and I want to try to compete at some level with tenants who may want to come into my building, I'm going to consider creating greater amenities or having a fancy state-of-the-art lobby, and thinking that that's really going to be what's going to bring in greater cash flow immediately than replacing my boiler from an 80% efficient boiler to a 95% efficient boiler. So I think what PACE does, it allows for energy efficiency to be part of this decision, and allows for both of these projects to be done. And in fact, it really does create greater overall cash flow for the property owner. Just it's not, bright and shiny like a lobby. So, the two groups I'm going to really discuss today are very closely aligned. The contractor is someone who we consider often as our channel partners because they really would like to sell more projects. That's what they're trying to do. They either are GCs, general contractors, or they're energy service companies and have specific equipment they want to sell. And, they come across, or come against the budget. And so really it served very effectively as a way to bridge this capital gap, and for these contractors to access smaller projects that they perhaps before wouldn't have done, because if it's under $1 million, they can't really, their cost of capital, their financing structures were not really, not set up for that. So in this way, because PACE can go down to even sub 100,000, it allows for smaller projects, smaller companies to take advantage of these great improvements. So really, I think contractors, we were just at an event actually 2 days ago in North Carolina, and saw contractors quite excited about the opportunity to use PACE. Next slide, please. And some of this I think Alyssa went over in her presentation, but I think it's important to really highlight and reaffirm the value it is to building owners. So, of course, as she mentioned, you don't get 100% financing from a bank. Energy service agreements can provide 100% financing up front, but they typically have more expensive capital costs, and often they will not do smaller projects. So if you have a $5 million project, that may be a consideration, but if you have a $500,000 project, it's probably not going to be feasible for an energy service contract. So really, that is a great benefit that we've seen for property owners. I would put that at number one. Also the fact that all the soft costs can be included in that typically. So an energy audit is a great tool. It can be really helpful, but often it's not executed because the property owner cannot see how that analysis is going to translate to actual money saved. And this way it's part of a whole package of providing the financing. Number two, I would say is, I think also Alyssa mentioned, is the term. Typically, bank loans are, 5-7 years, maybe an ESA, energy service agreement, would go out to 10 years, maybe 12. Sometimes banks can go out longer, but generally you're not going to get a 20-year term, 20 plus years if you're talking geothermal and solar, which have useful lives of the equipment that exceed 20 years. So really, this is something that, because of the long term, is going to lower your payment year over year and going to make it easier to bundle together different kinds of projects that will still have a savings over the term greater than the investment. So LEDs, LED lighting, they have very quick paybacks. So those can be put in there along with window replacement or things like that have maybe a 30-year payback. And so together, as a total weighted average in useful life, you're going to be able to qualify and therefore be able to really make these kind of deeper energy improvement projects feasible. And I would say another thing that's really important is the fact that really you're looking at lending on the building. Certainly you have to make sure that the borrower is, has a good payment history, is current on their taxes, hasn't had a recent bankruptcy, but you're really looking to the building itself to be the recourse. So we consider it non-recourse generally. Next slide, please. So this is, we're going to show two case studies. This case study, Bill Greenleaf and I, Bill is our next presenter, and I discussed that we would call this a bread and butter project. And what we mean by this is that, PACE can certainly be done for, $10, $20 million projects. I believe one of our partners is looking at a $20 million deal in Texas. But I would say that overall, the bread and butter are going to be your improvement projects on a mid-sized building, on a property owner that is, owns 5 to 10 buildings, is not a huge corporation whose cost of capital is not at 2.5–3%. So, $800,000 is a pretty, between $5 and $1 million is a pretty good range of where a lot of projects are falling these days. And this is an existing senior housing facility that need a lot of improvements. So, this is in Kentucky, and what I think is important about showing Kentucky compared to our state of Virginia is the fact that Kentucky does not have high energy costs. It does not have mandates for energy efficiency. The building code is similar to ours. So nonetheless, despite it not having, these extremely high energy costs, which would make a project pencil, really quickly, there was a true benefit to using PACE because they could replace equipment that needed to be replaced. They could do, solar PV, which was something they weren't going to do under any other kind of scenario, and because of the restrictions in their state. And they could do something they would have never been able to do under another kind of program, which was the elevator modernization. So speaking to the slide before, I mentioned is that, if you have LED lights, they have a huge savings right off the bat. That is going to compensate in your overall package of savings, energy savings, to the elevator upgrade, which, has a savings in energy, but it's pretty minor. But overall, the savings to investment ratio was greater than 1, which is typically the standard for allowing a PACE financing project to go forward. So they could basically do a wide variety of measures and still meet the program requirements. And as we see here, the term was for 20 years, and the rate, although it's not mentioned here, was in the low 6s. So it was really something the property owner would definitely do again, given the chance. Next slide, please. So this is a case study I would like to call the capital gap project. And what this means is that there can be projects that save a lot of energy, projects that make sense because you basically have a need to replace something today and don't have the capital. This capital gap project has more to do with a much larger big picture project where you're actually changing the building itself and use. So this was a historic building that was converted into a hotel, and as a result, it was a very large project, over $50 million in total project cost. And because of the nature of the project, how they were paying for the conversion, a mixture of brownfield credits, historic tax credits, these kind of deals typically have a big financing gap, have a big capital gap. And so because of the kind of conversion, you were able, if you can go to the next slide, has more detail, they were able to basically be eligible for over $8 million in energy and related measures. So they had a financing gap of $8 million per the construction budget. They were actually able to qualify for more than that based on the value of the property as improved. And so the building owner was actually able to finance $8.5 million for the conversion, and that basically saved them $500,000 in the equity they were initially going to have to put in the building. So basically, PACE acted as a debt source to this very large transaction. And what was great about it is that it was, had all these kinds of tax credits, which typically have to interact in a very particular way in order not to have recapture of the credits. And in this case, PACE simply acted as a loan. It acted as the financing. It wasn't in part of that other, rather complex, system of boxes and structures, master tenant, master landlord, et cetera. It just came in as a debt source and was able to reduce the equity of the property. So I believe that is the slides. That's all my slides for today. I think that Bill is going to discuss on the same line of reasoning the advantages of PACE over equipment financing.
Thank you. This is Bill Greenleaf with Virginia Community Capital. Let's go to the next slide. Virginia Community Capital is a 10-year-old community development bank. We got started in 2006 to make loans in the affordable multifamily sector, and I was hired last year to help the bank start their energy efficiency and solar lending program. Next slide, please. What I want to talk about is how a bank would finance a piece of, of solar equipment or HVAC equipment, one through the traditional way and the other through PACE. So most banks are only willing to lend up to 75% of a piece of equipment value for a 5 or 7 year term, and the loan will be fully amortizing, meaning you have to pay the loan back in 5 or 7 years. And under that model, the loan payments are going to be pretty high compared to the energy savings in a state like Virginia, where our energy costs are lower than some other states in the Northeast or the West Coast. If you're able to access PACE financing, you're able to borrow 100% of the project cost and secure a longer term loan. Therefore, you can make your loan payments smaller and to match the energy savings, so your project can be cash flow positive. So our bank is willing to make PACE loans. We're actively pursuing PACE loan opportunities in the Washington, D.C. PACE market. And we see it as a kind of a great tool. And the reason that a bank like ours is willing to do a long-term loan on the PACE project and up to 100% of project cost is because of the PACE lien being senior to the mortgage. It's lien status equal to a tax lien. Therefore, we have kind of extra collateral. So normally a bank would take the collateral being the equipment, and if we had to, in a default situation, if we had to liquidate or go repossess the equipment, it's not going to have very much value secondhand. But with the PACE loan, we have the extra collateral of a senior lien on the property. So that's why PACE loans or PACE lenders will do 100% financing long term. Next slide. So I've been working on trying to get PACE going in Virginia since 2009. The original legislation was introduced in 2009. It had a flaw that did not permit the PACE loan to have a lien status equal to a tax lien. So myself and some others, including Abby and some other organizations, in 2014 we built a business coalition to work on overcoming the legislative hurdles to getting the PACE law fixed. And so we were successful in 2015 to correct Virginia's PACE legislation. So now the PACE loan has a lien status equal to a tax lien. Since that time, Arlington County is moving forward with developing a PACE program, and will probably be selecting a PACE program administrator for their program by the end of the year, and hopefully starting a PACE program next year. Also, an anonymous foundation and awarded a PACE implementation grant to the Virginia Energy Efficiency Council this year, and the U.S. Department of Energy awarded a large grant to our state energy office to also help advance PACE in Virginia. So we're really excited to have the law passed and now get some funding in the state to help localities figure out how to create PACE programs and get them going. Next slide, please. So to kind of recap how a PACE loan works in Virginia, lender makes a loan, and the loan is repaid as a voluntary special assessment on the real estate tax bill. It has a lien equal to a real estate tax lien, so it's superior to the existing mortgage, but it does require the existing mortgage lender to consent and approve of the PACE lien being placed on the property. And the loan runs with the land, so meaning that if a current building owner sells the property, the PACE lien would stay on the real estate and the new owner would take it over, much like a real estate taxes stays with the property. Next slide, please. So I just want to do, that's the last of my presentation. I want to thank everybody for their participation, and I'll turn it back to Jessica.
Thank you everyone for participating in today's PACE in Virginia webinar, and a special thank you to our speakers. Here on the screen is the contact information for all of our speakers in case you have any questions and would like to reach out to them. Again, thank you everyone, and we look forward to having you join us in our next webinar series.